Behind the Metrics explores key accounting concepts by defining what they are, what they mean, and more. Inventory, at its most basic, is your goods on hand. There are typically 3 components under your inventory account: raw materials, work in progress, and finished goods. These are all considered part of your business assets. Inventory becomes tricky when you track it. For example, raw materials are the basic components that go into producing your products. When raw materials are purchased, you debit raw materials inventory and credit accounts payable. Once your product goes into production, costs are broken into 2 categories: direct and indirect. Direct costs can easily be identified to one unit, while indirect costs are related to the production progress but not easily identifiable to one unit. Once the production of the unit is complete, you would debit finished goods and credit work in progress. Ideally, you'll be tracking those finished goods by inventory item, SKU, or some other identifier, and will increase your inventory ledger by the units and cost completed, so your inventory ledger agrees to your finished goods account. As you can see, it gets complex and can be confusing. Inventory can tell you the value of the assets, your profitability, and your cash flow. Questions to consider include: how much inventory do you have on hand versus what's going out the door, and if you recoup the costs of production when your inventory sells. Other metrics to be considered within inventory include inventory turnover, how often is your inventory sold out and replaced, days sales of inventory, how many days does it take to turn inventory into sales, and inventory days of supply, how long will current inventory last based on current sales levels. Inventory management is important, and it has a direct effect on your business. For help with tracking your inventory, as well as managing your finances and growing your business, visit eidebailey.com.